No, not literally every American has lost hope, but millions feel something close to it. They hear that the economy is growing, then watch groceries, rent, insurance, utilities, and debt payments swallow the raise they waited years to get. This story explains why the official economy can look stable while ordinary life feels increasingly fragile, how everyday pricing systems quietly drain household budgets, and what the numbers actually say without pretending the pain is imaginary. The frustration is not abstract. It appears each time a routine purchase demands a new sacrifice. The national mood is not simple despair. It is distrust. People no longer believe that a strong headline guarantees a stronger household because the distance between national statistics and personal reality has become impossible to ignore. A country can add jobs, post economic growth, and still leave families feeling trapped. Those facts are not contradictory. They measure different things, and the gap between them is where frustration grows. That is the emotional contradiction at the center of this story, and it keeps widening. The economy is usually described from 30,000 feet. Households experience it at the gas pump, the pharmacy counter, the rent portal, the insurance renewal, and the grocery checkout where a normal cart suddenly feels like a luxury purchase. A household ledger can weaken even when the national scoreboard appears to improve. That difference matters because people do not live inside averages. They live inside monthly deadlines. A statistic can improve while the bill due Friday remains painfully unchanged. People notice the gap because they have to balance it with real money every month. Recent federal data showed consumer prices were still rising, even after the explosive inflation of earlier years cooled. Slower inflation does not mean prices went back down. It means they were climbing more slowly from a much higher base. The damage is often gradual, which makes it easier to dismiss and harder to escape. That single distinction explains much of the anger. Officials celebrate a lower inflation rate. Shoppers hear the word lower and wonder why cereal, rent, electricity, and car insurance still cost so much. A slower climb still leaves families standing on a price level they never chose. Imagine climbing a steep hill, then slowing your pace near the top. You are still much higher than where you started. That is what many household budgets have experienced since the pandemic era. Language that sounds precise in a briefing can sound evasive in a kitchen. Wages also rose for many workers, and that matters. But the timing was uneven. Prices often moved first, paychecks adjusted later, and some families never fully caught up after rent, food, transportation, and borrowing costs were counted. The past price shock remains embedded in bills long after the headlines move on. Even when income catches up on paper, people remember the years when it did not. Financial confidence is shaped by accumulated stress, not only by this month's percentage change. Recovery therefore depends on purchasing power, not merely a better rate of change. A recent Federal Reserve household survey found that roughly 3/4 of adults said they were doing okay financially or living comfortably. That sounds reassuring until you notice that price increases still ranked as the most common financial concern. Memory turns earlier losses into present caution, even when conditions stabilize. Both things can be true. Many Americans are surviving. Many are also worried that one medical bill, job interruption, car repair, or rent increase could knock the entire plan apart. Hope weakens when progress feels reversible. A household may finally build a small cushion, only to lose it to an insurance premium, a broken transmission, or a week of reduced hours. The survey captures endurance, but it also captures how fragile that endurance can feel. The emotional center of this economy is not always poverty. Often, it is precarity. The feeling that stability exists only as long as nothing goes wrong. Survival is not the same as confidence, and comfort is not always the same as security. That is why consumer confidence can move differently from employment data. A person can have a job and still feel economically unsafe. Employment answers one question. Security answers several more. One bad month can convert a careful plan into a balance carried for years. The grocery store reveals this tension better than almost any chart. Food is unavoidable, frequently purchased, and easy to remember. Shoppers see the same products week after week, so changes feel personal. precarity changes behavior before it ever appears as an official crisis. A family may not track a formal price index, but it knows when a familiar bag is smaller, a weekly total is higher, or a promotion now requires an app, a membership, and a carefully timed purchase. That is why a paycheck alone cannot settle the argument about economic strength. Food prices are affected by weather, disease outbreaks, energy, labor, transportation, packaging, commodity markets, and global supply chains. Retailers also make pricing decisions based on competition, inventory, demand, and profit targets. Food makes inflation visible because the comparison returns every few days. That complexity is real. But complexity can also become a shield. When every increase has a different explanation, consumers struggle to tell which costs are unavoidable and which are strategic. The shopper may forget a statistic, but rarely forgets the shock of the total. Start with the shelf tag. The large number gets attention, but the unit price often tells the truth. A cheaper package can cost more per ounce, per pound, per sheet, or per serving. Every link in the chain can add cost, delay, waste, or bargaining power. Unit pricing is one of the most useful tools in a store, yet it is easy to overlook. Labels may use different units, small print, or inconsistent formats, making fast comparison harder than it should be. Without transparency, legitimate explanations and opportunistic choices blur together. Government researchers have noted that clearer, more consistent unit pricing could help shoppers detect downsizing. That matters because package shrinkage can hide an effective price increase without changing the number printed in bold. Shrinkflation is not a conspiracy theory. Federal inflation statisticians explicitly track product size changes because getting less for the same price raises the cost per unit. A small unit price difference becomes meaningful when repeated across a full cart. The trick works because human memory stores the package, not always the quantity. The box looks familiar. The color looks familiar. The price may look familiar. The missing ounces are easier to miss. Comparison should be simple, yet the burden often falls entirely on the customer. A deeper curve in the bottom of a container, fewer sheets on a roll, more empty space in a bag, or a redesigned bottle can quietly change value while preserving the feeling of continuity. Clear information matters most when packages are designed to look unchanged. Sometimes downsizing reflects higher production costs. Sometimes it helps protect margins. Either way, the shopper pays more for each usable unit, and that pressure rarely appears as one dramatic moment. Official measurement recognizes what many shoppers already sensed at home. It appears as 100 small moments. The package runs out sooner. The second purchase happens earlier. The household wonders why the pantry empties faster, even though shopping habits have not changed. The visual familiarity is the point. It reduces the chance of a fresh comparison. Then there is the sale price. A bright tag can create urgency, but a discount is only valuable relative to the normal price, the unit price, and what the item costs elsewhere. The container can stay tall while the useful quantity quietly falls. Retail pricing often uses anchors. A high regular price makes a temporary discount look generous. The emotional comparison happens inside the store, even when the final price is not especially low. Whatever the cause, the budget experiences the change in the same direction. That does not mean every promotion is fake. Many are real savings. The problem is that shoppers must now perform constant mental auditing just to know whether a deal deserves the word deal. Households feel the loss through repetition rather than one dramatic receipt. Loyalty programs add another layer. They can save money, but they also divide the shelf into two prices, one for members who share data and follow the rules, and another for everyone else. A sale deserves scrutiny when it changes the basket more than it lowers the bill. The lower number is usually displayed more prominently because it attracts attention. A shopper who misses the membership condition may discover the real total only at checkout. The program can reward regular customers, but it also gives retailers detailed information about what people buy, when they buy it, how often they respond to discounts, and which products keep them coming back. The first price shown becomes a mental reference, even when it is not competitive. That data can improve inventory and personalize offers. It can also make pricing less transparent, especially as digital systems become better at predicting what an individual shopper is likely to accept. Real savings survive comparison. Weak savings depend on urgency and confusion. Federal regulators have examined the growing use of personal data in targeted pricing. The concern is not that every grocery item already has a secret price for every person. The concern is that the technology and incentives are moving in that direction. Membership can be useful, but usefulness should not be confused with simplicity. Location, browsing behavior, purchase history, device information, and responses to earlier offers can all become signals in modern pricing systems. The line between helpful personalization and extraction can become thin. That surprise at the register is where trust begins to break. A coupon once required scissors. Now it may require an account, a smartphone, notifications, location access, and time spent searching through dozens of digital offers. Data turns ordinary shopping into a detailed behavioral record. That labor is unpaid. The shopper supplies attention, data, and planning in exchange for access to the price that once might have been available to everyone. Personalization can serve the customer, the seller, or both, depending on the rules. People with less time, weaker internet access, limited English, disabilities, or no smartphone can be placed at a disadvantage. The system rewards not only thrift, but also digital capacity. The future risk is greater when consumers cannot see how the price was produced. This is one reason two shoppers can leave the same store with nearly identical baskets and different totals. One knew the app, one missed the offer, one bought on the wrong day, or one selected the wrong package size. A system that knows more about the buyer gains leverage in every small decision. The modern grocery bill is not just a price. It is a test of timing, comparison, memory, membership, and attention. Exhausted people are expected to pass that test after work, childcare, traffic, and every other demand. The cost of the discount may include attention that the receipt never records. Store layouts also shape spending. Essentials are often spread across the building, encouraging shoppers to pass more products before reaching everything on the list. End displays create visibility. Checkout lanes create temptation. Bakery smells, ready-to-eat foods, seasonal tables, and limited-time signs turn a practical errand into a sequence of emotional decisions. People with the least spare time can end up paying the most for missing a step. None of this is illegal or mysterious. It is retail design. The store is built to sell more, while the shopper is trying to spend less. Those goals are naturally in conflict. That variation feels arbitrary even when every condition appeared somewhere on screen. Eye-level placement matters because attention is scarce. Products that are easiest to see and grab are not always the best value. Lower shelves and less glamorous corners may hold cheaper alternatives. Fatigue is not a personal failure. It is a predictable limit that sellers understand. Suppliers and retailers may negotiate fees, promotions, displays, and shelf access. The visible aisle is partly a map of consumer demand and partly a map of business relationships the shopper never sees. More exposure means more chances for an unplanned item to enter the cart. That does not prove the highest-priced product bought its position. It means shelf space is commercial real estate, and every inch has economic value. Each queue is small, but the store only needs a few of them to work. Private label goods complicate the story in an interesting way. Store brands are often cheaper than national brands, and research has found that competition between them can increase choice and put downward pressure on prices. The design is effective precisely because it feels normal rather than forceful. But private labels can also generate stronger margins for retailers and deepen customer loyalty because the same product is not sold by every competitor. Convenient placement often wins before a shopper consciously compares alternatives. So the store brand may genuinely save the shopper money while also strengthening the store's control over the relationship. Both incentives can operate at once. The shelf is a marketplace inside the marketplace with its own hidden negotiations. Private labels have also moved beyond plain budget packaging. Many retailers now offer basic, standard, organic, premium, and specialty tiers under their own control. Visibility can reflect demand, promotion, strategy, or some mixture of all three. That creates a price ladder inside a single store. The cheapest option attracts value seekers. The premium version captures shoppers who want indulgence without choosing a famous national label. The danger is not the existence of premium food. The danger is category drift, where ordinary products slowly acquire luxury language, smaller portions, elaborate packaging, and a higher margin. The cheaper choice can be good for the family and profitable for the retailer. A simple snack becomes artisan. Water becomes enhanced. Salt becomes curated. Convenience becomes lifestyle. The product may improve, but the marketing also changes what feels normal to spend. That dual benefit explains why store brands have become central, not secondary. Premiumization works because consumers do not buy only calories or ounces. They buy identity, reassurance, health claims, convenience, status, and the promise that one small purchase can make a hard week feel better. That burden is easy to underestimate. That promise is powerful during economic stress. People may postpone a house, a trip, or a new car, then protect a few affordable indulgences because larger goals feel unreachable. Economists sometimes call this trading down in one category and treating yourself in another. The household skips a restaurant, then buys the premium dessert at the grocery store. From the outside, spending still looks resilient. From the inside, it may represent substitution, not confidence. People are not necessarily thriving. They are rearranging disappointment. This is why retail sales can remain strong while public sentiment stays weak. Spending is not always optimism. Sometimes it is necessity. Sometimes it is stress relief. Sometimes it is a bill paid with debt. A dollar of spending does not reveal whether it came from rising income, reduced savings, a credit card balance, or a household delaying another expense. The same ambiguity appears in restaurant and grocery delivery. The app offers convenience, but the final charge may include higher menu prices, service fees, delivery fees, small order fees, taxes, and a tip. Federal regulators have asked whether delivery platforms clearly disclose price differences and mandatory charges. That question exists because the advertised convenience can obscure the full cost until late in the transaction. A shopper may see free delivery and assume the order is inexpensive. But free delivery does not necessarily mean no fees, no markup, or the same item price offered inside the store. The frictionless screen changes behavior. Adding one more item feels easier than walking another aisle. Stored payment information removes the pause that cash once created. Convenience is not foolish. For a parent with a sick child, a worker without a car, an older adult, or someone with limited mobility, delivery can be essential. The honest question is not whether convenience is good or bad. It is how much it costs, how clearly that cost is shown, and whether the buyer had a realistic alternative. Subscription programs make the calculation harder. A monthly fee can reduce visible delivery charges, but it may also encourage more frequent orders to justify the membership. Once someone thinks, "I already paid for this," the next order feels cheaper than it truly is. The subscription becomes a reason to spend, not only a tool to save. This is the same psychology behind warehouse memberships, streaming bundles, premium banking tiers, and loyalty clubs. A sunk cost can quietly shape future behavior. Coupons use another powerful mechanism: the fear of wasting a discount. A person may buy 2 items to save on one, even when one item was all the household needed. Stocking up can be smart for stable goods that will definitely be used. It can also trap cash in a pantry, increase waste, or create the illusion of saving while total spending rises. The right question is not, "How much did I save?" It is, "How much did I spend compared with what I actually needed?" Retail receipts emphasize savings because savings feel like a reward. But a receipt can say you saved $20 after persuading you to spend $100 you had not planned to spend. The figure at the bottom matters more than the celebration near the top. A discount is not income. It is a reduction from a reference price chosen by the seller. That reference price may be fair. It may also be temporary, inflated, or irrelevant to what competing stores charge. Consumers rarely have enough time to verify every claim. This information burden is one of the quiet costs of the modern economy. To protect a household budget, a person must become a part-time analyst of prices, fees, contracts, interest, and fine print. The better someone becomes at comparison shopping, the more they notice how much effort the system demands. Frustration grows not only from paying more, but from having to fight constantly to avoid paying too much. Now zoom out from groceries. Housing remains the largest expense for many families, and it cannot be solved with a coupon code. Renters face renewals, deposits, moving costs, application fees, and limited supply in desirable areas. Homebuyers face prices, insurance, taxes, repairs, and mortgage rates that can transform the monthly payment. A home price can stay unchanged while affordability worsens because the interest rate changes the cost of financing. That is why buyers can feel locked out even when headlines say the housing market is cooling. Owners with older, lower-rate mortgages may feel locked in. Moving could mean giving up a favorable loan for a much more expensive one, so families stay put even when the home no longer fits. That reduces available inventory in some markets and makes the economy feel frozen. The person who wants to buy cannot find an affordable option. The person who wants to move cannot justify the payment. Housing also explains why national averages can feel insulting. A moderate rent increase in one region does not help a tenant facing a sharp renewal in another. Insurance adds another strain. Premiums can rise because of repair costs, medical costs, litigation, weather risk, theft, local regulation, and insurer decisions. The household only sees the new bill. Car ownership has become a chain of expenses: purchase price, financing, insurance, fuel, maintenance, registration, parking, and repairs. In many communities, avoiding those costs is not practical because work and housing are far apart. When transportation is mandatory, higher costs behave like a tax on participation. People pay simply to reach the job that pays the bills. Interest rates spread through the economy unevenly. Savers may earn more on deposits. Borrowers may pay more on credit cards, auto loans, business loans, and mortgages. For a household carrying variable rate debt, an interest increase can erase the benefit of careful budgeting. The product was purchased months ago, but the cost of carrying it keeps changing. Credit cards make financial pain easy to delay and expensive to extend. The minimum payment protects short-term cash flow while allowing interest to consume future income. Debt is not always a sign of irresponsibility. It may reflect medical care, a necessary repair, lost work, education, relocation, or a gap between wages and basic costs. But once interest compounds, yesterday's emergency competes with today's groceries. The household becomes less able to absorb the next problem, and hope narrows. This is where the phrase "strong consumer" can become misleading. A consumer can keep spending because the rent is due and food is needed, not because the consumer feels strong. The labor market tells another mixed story. A low unemployment rate can coexist with weak bargaining power, unstable hours, limited benefits, long commutes, or work that does not cover local housing. Job counts do not measure whether a schedule is predictable, whether childcare is affordable, whether health insurance is usable, or whether a worker needs 2 jobs to stay current. A raise can also move a family above an eligibility cutoff for assistance before the new income fully replaces the lost benefit. The result can feel like earning more and falling behind at the same time. Workers hear that productivity matters, but many do not see a clear connection between greater output and greater security. When effort rises faster than control over time, pay, and benefits, confidence erodes. Remote work briefly changed the calculation for some households by reducing commuting and expanding job options. Its retreat in many workplaces brought back transportation, meals, clothing, and childcare costs. For employers, office policies involve collaboration, management, leases, culture, and business needs. For employees, the same policy can be a direct change in the monthly household budget. The economy also looks different depending on whether a person owns assets. Rising home values and stock prices can build wealth for owners while making entry harder for everyone outside the market. This is a central source of resentment. The same price increase can enrich the owner and exclude the renter. The same market rally can reward retirement accounts while doing little for a household with no savings. Wealth creates resilience. It allows a family to buy in bulk, wait for a better price, handle a deductible, move for a job, or avoid high-interest debt. A shortage of cash makes everything more expensive. People pay late fees, overdraft charges, rush shipping, smaller package unit prices, and higher financing costs because they cannot pay earlier or buy more at once. Economists sometimes describe this as the poverty premium. The basic idea is simple. Having less money can force choices that cost more over time. That is why personal finance advice can sound detached when it ignores structural constraints. Cooking at home helps only if there is time, equipment, transportation, storage, and predictable access to ingredients. Buying in bulk helps only if the household has cash, space, and confidence the product will be used. Moving somewhere cheaper helps only if work, schools, safety, healthcare, and family responsibilities allow it. A budget is useful, but it cannot negotiate rent, lower an insurance premium by force, or create an affordable daycare opening. Still, household choices matter. The truth is not that people are powerless. The truth is that individual discipline operates inside systems with prices and rules individuals do not control. The strongest financial advice respects both sides. It avoids blaming people for every hardship, and it avoids pretending that every spending choice is irrelevant. Consider convenience habits. Small charges feel harmless because each one is judged alone. The subscription, delivery fee, prepared meal, ride, rush order, and automatic renewal become expensive only when combined. The brain is poor at feeling cumulative cost in real time. 10 separate purchases feel smaller than one bill, even when the total is identical. Automatic payment increases convenience and reduces missed bills, but it can also hide recurring expenses. A service can remain active long after its value disappears because cancellation requires attention. Companies know that inertia is powerful. A customer who does nothing is often more profitable than a customer who reviews every charge. That incentive does not require a secret meeting. It is built into subscription economics. Retention improves revenue, and friction can improve retention. Some businesses make cancellation easy. Others place it behind menus, chat windows, retention offers, or phone calls. The customer's time becomes part of the price. The same pattern appears in free trials. The trial removes the decision to pay today, while the automatic renewal moves the real decision to a future moment the customer may forget. This is legal when disclosed properly, but legality does not erase the behavioral design. A system can be transparent in fine print and still be difficult in practice. That phrase applies to much of the economy. Technically disclosed, emotionally obscured. The fee exists, but late. The condition exists, but small. The cheaper option exists, but takes work to find. Hope declines when people feel every transaction is a negotiation against a better-informed system. Corporate pricing deserves careful language. Companies are not charities. They set prices to cover costs, compete, invest, survive, and earn profit. Profit itself is not proof of abuse, but businesses also test what customers will tolerate. If demand remains strong after a price increase, there is little incentive to reverse it merely because some input costs later ease. Prices are sticky on the way down for many reasons. Labor contracts, rent, transportation, packaging, financing, and expectations may remain elevated. Companies may also prefer to preserve margins. This is the uncomfortable truth. Inflation can begin with real shortages and rising costs, then become an opportunity for some firms to learn that customers will accept a higher price. That does not mean every price increase is greed. It means cost pressure and pricing power can exist together, and public debate becomes dishonest when it allows only one explanation. Competition is supposed to discipline pricing. When shoppers can easily switch and rivals fight for business, companies risk losing customers if they push too far. But switching is not always easy. A town may have few grocery options. A worker may have one practical insurer. A tenant may face similar rents everywhere nearby. A family may depend on one internet provider. Concentration does not automatically prove illegal behavior. it can still reduce the pressure to compete aggressively on price, service, or transparency. Consumers feel this as a shrinking field of choices. Different logos may exist, but the monthly bill remains stubbornly similar. Government policy also shapes the outcome through taxes, spending, interest rates, trade rules, zoning, energy policy, healthcare rules, labor law, and enforcement. No president controls every price. No central bank controls every supply shock. No corporation controls the whole economy. Anyone offering one villain for everything is selling emotional simplicity. But responsibility being shared does not mean responsibility disappears. Policy choices matter. Corporate choices matter. Consumer behavior matters. Market structure matters. Timing matters. The honest explanation is less satisfying than a slogan because it requires several causes at once. Yet that complexity is the only way to understand why economic pain persists after the loudest crisis has passed. Inflation statistics measure average price movement across a broad basket. Your personal inflation rate depends on what you buy, where you live, whether you rent, how much you drive, and what medical or childcare costs you face. A household that spends heavily on a rapidly rising category can feel much more pressure than the national average. Another household may be protected by a fixed mortgage, employer benefits, or lower exposure. This is why arguments over whether the economy is good or bad become so bitter. People are often describing different economies while using the same word. For an asset-owning professional with stable benefits, the economy may feel resilient. For a renter with variable hours and a long commute, the same economy may feel punishing. Neither experience cancels the other. The mistake is turning one experience into a universal verdict. Even the title of this story is deliberately provocative. Every American has not lost hope. Some households are prospering, some are recovering, some are struggling. The real warning is that distrust has spread far beyond those in official poverty. Middle-income families increasingly describe a life of constant trade-offs. Replace the tires or visit relatives. Save for retirement or cover childcare. Fix the roof or preserve the emergency fund. These are not always signs of collapse. They are signs that the margin for choice has narrowed, and choice is a major part of what people mean when they say freedom. Economic hope is not merely believing next quarter will grow. It is believing that effort can produce stability, that saving can create progress, and that a surprise will not erase years of discipline. When those beliefs weaken, people postpone marriage, children, education, home ownership, entrepreneurship, medical care, and retirement. The effects reach far beyond consumer sentiment. A society built on delayed goals becomes cautious and angry. People stop seeing institutions as imperfect helpers and start seeing them as machines designed to extract. Some of that suspicion is exaggerated. Some of it is earned. The only credible response is greater transparency, stronger competition, simpler pricing, and policy that respects how households actually live. For shoppers, the most practical defense begins with slowing down the comparison. Check unit prices, not only package prices. Compare the final cost, not the size of the advertised discount. Treat loyalty prices as conditional prices. Ask what data, membership, timing, or quantity is required, and whether the offer changes what you plan to buy. Compare store brands by ingredients, quantity, and use, not by the assumption that cheaper means worse or premium means better. When a package changes, look at the weight or count. Familiar design is not proof of familiar value. For delivery, compare the full checkout total with the in-store or direct price when practical. Free delivery can coexist with other charges and markups. Review subscriptions as a group rather than one at a time. The total monthly drain is easier to understand when every recurring charge sits on one page. Before using a coupon, ask whether you would buy the item without it. Before stocking up, ask whether the product will be used before it expires or loses value. Build a small list of reference prices for the products your household buys constantly. Perfect tracking is unnecessary. A few reliable benchmarks can expose weak promotions. Use convenience intentionally. Paying for saved time can be rational. The goal is to know when convenience is solving a real problem and when habit is quietly choosing for you. These actions will not fix housing supply, medical pricing, wages, or interest rates. They can reduce leakage, restore some control, and make hidden trade-offs visible. The larger solutions require institutions. Clearer fee disclosure, consistent unit pricing, competitive markets, usable consumer protections, affordable housing, and credible economic communication all matter. People do not need officials to tell them their pain is fake. They need an explanation that separates lower inflation from lower prices, national growth from household security, and spending from confidence. They also need companies to understand that trust is an economic asset. A customer who feels manipulated may keep buying for a while, but loyalty built on confusion is fragile. The next phase of the economy will not be judged only by whether inflation slows. It will be judged by whether ordinary people regain breathing room. Breathing room means income left after essentials. It means a repair does not require debt. It means a grocery trip does not demand a strategy session. It means planning farther than the next due date. That is the real measure missing from many arguments. Not whether the economy is technically expanding, but whether life feels more possible. So remember the core truth. Prices can rise more slowly and still feel painfully high. Spending can remain strong while confidence weakens. A job can exist without security. A discount can encourage overspending. Convenience can conceal cost. Grocery pricing is not one simple trick. It is a web of package sizes, unit prices, promotions, data, shelf placement, private labels, premium tiers, memberships, and human fatigue. The broader economy is the same kind of web. Housing, debt, wages, insurance, transportation, assets, and policy interact, creating very different realities for different households. Americans have not all lost hope, but too many have lost confidence that the rules will reward patience, work, and restraint. That is serious enough without exaggeration. The way back begins with honesty. Honest statistics, honest prices, honest fees, honest competition, and honest recognition that national success means little when households cannot feel it. Like this video if it gave language to something you have been feeling. Share it with someone who keeps hearing that the economy is fine. Then comment with one specific question. Which everyday expense has changed your sense of financial security the most?